All right. Good afternoon, everyone. Can you all hear me?
Yes.
All right. So let's start with the question that Samson asked. So when you go, let's open that question. Let's everyone open that question. Let me quickly explain that. When you check that question, I told you the principle of working capital. I explained that working capital, as we know, is the capital that we used for the day-to-day running of every business. And then if you want to invest in a particular asset, the cost of that asset is not only the money you are going to spend on that asset that very year. You also need to bring in some working capital that you will use to put the asset in a good condition and bring it to the business premises and make sure that the asset is ready for use. So the analysis of working capital is that it is assumed that working capital is being borrowed into the business because the business has not started generating any income. The business have not started generating any income. So as such, you would borrow certain funds to, take care of the asset and also any other incidental cost that you're likely to bear. So working capital at first is expended in the very year of that investment, that cost of that year wherein the asset will be bought, working capital will be expended. And at the end of the useful life of that asset, you are going to recover your working capital. So when you recover your working capital, it's like you are now bringing back the money you spent initially, the money you borrowed from either the business or anyone. You are now bringing it back into the business. So when you are bringing it back into the business, it's an inflow to you. It's no longer an outflow, it's an inflow to you. So the rule is that in the year zero, working capital is an outflow because you spend it to take care of the incidental cost and every other thing you will need in the business, because the business have not started generating income at year zero. The business have not started generating any sales at year zero, but you will need money to take care of other things. You can't say because the business has not started generating money, you would not do certain things in the business. It's just like if you have a shop today and you put in the shop in place and the other, you get the building and all of that. Getting the building is not what make that shop ready for use. You also need to put in lighting, you need to put bulbs, you need to put security, you need to do anything that you need to do to ensure that shop or that rented apartment is ready for use. So you cannot say because you have not started making money, you won't bring in um, you won't bring in you won't bring in um, access, you won't bring in working capital to finance the business. So you must bring in money. So that money that you bring into the business is what we refer to as the working capital outflow. So you spend it at that year zero, and then in the last year of the asset, when you want to sell the asset, you would recover your money back. That's how working capital is treated. So in the following year, for instance, now we have year 1 to 5. You will be given in the question that working capital would increase by a certain percentage. So the increment is what you will be adding into the following years. Let's say, for instance, now year one, the working capital is 20,000. I mean, for year zero, working capital is 20,000. You put in the 20,000 for year zero as an outflow. Then they now said that in the question, working capital would increase by 5%. I hope you guys are listening to me. Can you hear me?
Yes, I'm with you.
Okay, so they now say working capital would increase by 5%. So what that means is that 5% of that 20,000 year zero is how much? That is 1,000 naira. So for year one, the amount you are going to put as working capital is 1,000 naira. It's not the total amount of working capital used initially plus the increment. You are not putting both of them together. You are just putting only the increment. So for year one, you put only the increment, which is what? 1,000 naira. Then you do the same thing for year two. You look for the 5% of that. The total now will be 21,000. Look for the 5% of it. Let's say the 5% of it is 1,500. So the total on the money now is now 22,500. So for year two, what you are going to put there is just the 1,500. It's just the 1,500 that increased from that year one to year two. The increment is what you will be adding. When you now get to the year five, you will now add up all the increment for both year one to year four, plus the initial working capital that was used. Everything, you will now recoup it at the end of that year five. So at the end of that year five, it will now become an inflow to you. So let's assume year one is 1,000, year two is 1,500, year three is 1,000, year four is 1,500. Don't forget that all of those things, they are all expenses, outflow. So you will add everything together now. That 20,000 in year zero, plus the 1,000 in year one, plus the 1,500 in year two, plus the 1,000 in year three, plus the 1,500 in year four. If everything gives us, let's say 26,000, that 26,000 is what you will now put in year five as an inflow. Now you are not putting it as an outflow, but rather you are putting it as an inflow. That's how working capital is treated. Do you understand?
Yes. But please, as for this particular question, I don't know, maybe you have it in front of you.
Okay, the one we treated yesterday, Abby.
Yes.
Okay,
He
let
said,
me open it.
okay.
Okay, ask your question. I've opened it.
Okay, they said initially Ferrari PLC will require additional working capital for the project of 20% of the first year's sales revenue. I did that one, I got it. But so then they said thereafter, every 1 naira increase in sales revenue will require a 10% increase in working capital. So
Okay.
for the remaining years, I tried to do it. I didn't know how they come about with the figures.
Okay, so that is still what I've explained. Now let's go to the working capital calculation.
Okay.
Go to the working capital calculation. Can we see the working capital calculation there?
It's not clear.
Okay, the working capital calculation is okay, it's not clear.
Yes.
Okay. Okay, just hold on. Let me snap that part. I didn't know that place is not clear. So you would see that, let me snap that part to you. You will see that, I'll snap it and send it to the group now. You would see that it is the same explanation that I've given that was used in the question, but nevertheless, let's quickly look at something here. So, if you look at that question very well, it's very straightforward. I'm coming on. Let me lay my hands on where the particular question is. And that's Ferrari. Okay, so I've seen it. So working capital. I don't want to use mouth to explain it without us seeing it so that we would not okay, this is it. So I've sent the working capital angle to the group now. Let's check the working capital. Let's open the working capital to the group. Please, I hope everyone is with me.
Yes.
Okay, so let's just flow along with what is explaining so that we can understand it better when we are going through it. Have we seen it? So check the working capital I just sent to the group now. So what is there is actually, now when you open this now, the working capital says additionally, the firm is going to incur how much? How much working capital of sales? It says the firm is going to incur an additional working capital of 20% in the first year of sales. Now listen to that. It says the firm is going to incur an additional 20% in the first year of sales. And then subsequently, every 1 naira increase in sales revenue will require a 10% increase in working capital. So what that is saying is that for first year, it is 20% increment.
I'm not seeing where you're
20%
reading
increment.
from.
Hello, what do you say?
I can't see where you're reading from. Was it the one you just sent now? Because it's not there.
I'm reading from the material that was sent yesterday. Open the material that was sent yesterday. Can you see that? Open the material that was sent yesterday. You would see
Okay.
yes, so that's where I'm reading from. So basically, the question says that the firm is going to incur. Huh?
What page is it? What page?
What page of the material? That's illustration 5.
Okay.
Is the question we treated yesterday. So the question says that the firm is going to incur an additional 20% working capital in first year, but subsequently is going to be what? 10% for every 1 naira increase in sales. So what that means is that it's very simple. If 1 naira, what that 1 naira means is that in as much as there will be sales value in the next year following, it must be 10%. You get? You don't be confused about, oh, what they say 1 naira increase in sales value should be 10%. So if sales value is now 50,000, then let it be 10,000 multiplied by 50,000, and so that I will not get the increment. No. The statement means, what that statement means is that in as much as there will be an increase in sales value, or in as much as there will be a sales value, there will be an increase from the initial sales value that we have in year one, in as much as there will be an increase in the next year, the working capital percentage should be 10%. That's what that means. So what it means is that from that year two going forward, it will be 10%, 10%, 10%, 10%. So what you will just do is, if you see that the sales value is 30% for year one, what's the 20% of it? 20% of it is what? What's the 20% of 30,000?
6,000.
6,000 naira. So that's how they got the increment of 6,000 naira there. You do the same thing for year two now. Year two will now be what? 10%. It will now be 10% of when you add the initial 30,000. See, okay, when I think I've seen where you are confused. The way they did their own, Abi, they did it in a way that is looking somehow. It's still the same thing, but it's just that the way they solve the question, they are professionals. But once you understand the process of increment, just go ahead. Let's do it manually from our end and see. $30,000, 20%, that's 6,000. That's 3,600. I'm coming. That's 3,000, 3,600, 30,000. Increment inflation. Okay. This is no, this thing is not supposed to be like this. Okay. Can you all hear me? Hello, can you all hear me, right? Okay, let me chip in something here. What is here is still the same thing what I have explained before. And what they just did is they broke it down for you to understand what that statement is saying. So the every 1 naira increase. So what they did was that, first of all, they gave you the sales value initially, which is what we can see. We can see from that total sales. So that total sales is what we were given before initially. Then the incremental amount after the year one, they now brought it out. So year two is 86,400 and year one is 30,000 naira. So the difference, what's the difference? The difference is 56,000 naira. That's the increase. That's the increase. And the question says that for every 1 naira increase in sales, there should be 10% increase in what? Working capital inflation rate. So they brought out the increase, which is what you can see here, incremental sales. For the other one too, they brought out the increase. That's the difference between year three and year two. They brought out the increase to be 146,900. The other one, they brought out the increase to be 86,980. The other one, they also brought out the increase to be what? 214,710. So what you just do is just to apply the rate. Apply the rate on the increase. You get, because they follow the question. It is what you are being told in the question that you are going to do. It doesn't mean the working capital principle that I've said is wrong. That's the same way that it was calculated. But they made it so simple in the sense that they followed the requirement of the examiner. So the percentage increase was done on the what? On the incremental sales value for each of those periods. So once you do for the first one, year one, 20% on 30,000 will give us 6,000 naira. 10% on the increase of year two, which is 56,400. That is what gave us this 5,640. 10% on this other one gave us this. 10% on this other one gave us this. 10% on this other one gave us this. So what you will now do is, after you have gotten that now, for your year zero, your working capital will be 30,000, because that's the working capital that you were given before. Your working capital will be 30,000. Is it 30,000? Wait, let me check. Your working capital would be, what was the working capital we were given in the question before? That is working capital incurred in year zero, additional 20% working capital sales. No, it's not this one I'm looking for. So your working capital would be 30,000 for year zero. So under year zero, where your initial cost of assets is, you put 30,000 there. For year one, your working capital will be 6,000. Year two, your working capital will be 5,400, 5,640. Year three, 14,690. Year four, 6,898. Then year five will now be the recouping year. When you add up all of these figures together, what do you have? Let me see. Add from year one to year four, what do you have? Add year one to year four together, what do you have?
$54,699.
54
$699.
699. So that 54,699 is what you are now going to recoup in year five, which is the final year of the assets. So what they did here, you can see they joined their own. Normally, you see, can you see this under this relevant year that is here? Can you see that relevant year? That you have 0, 1, 2, 3, 4, 5. Can you see that? Can we all see that?
Yes.
So normally that year zero is not supposed to be part of this year 1, 2, 3, 4, 5. Year zero is supposed to stand alone. You know, that's why you can see their own calculation. Year 5 stood out. Year 5 stood out as the total. We are still saying the same thing, but they are taking it in another dimension. But all what we are saying is still the same thing. You know, so, and I would prefer you to go with what I've been saying. Just understand how working capital is treated. That's the same thing you should apply. It doesn't, if you check the calculation, that's the same thing they did there. You get? So once you do that, recoup all your working capital in year 5, you will get your answer. That's how working capital is being treated. I don't know if it's clear.
Yes, it's clear.
So you talked about trainings and development, right?
Yes.
So let's look at the trainings and development. So where is the statement that talked about trainings and development? Quickly. The research studies conclusion and the
The variable and fixed costs are expected to increase by 5% per year for the next 4 years. Then training and development costs are expected to be 120% of variable cost in the first year, then 40% in the second year, and 10% in each of the following 3 years.
Okay, and so that's it now. So you do the same thing. You will just apply the same principle to it. I'm still trying to, where did you see the statement now? I'm trying to get the statement. I've not, where did you see it?
Before the table of unit produced and quantity sold.
Okay, yeah, okay, great. I've seen it now. Okay, so trainings and development costs are expected to be 120% of variable costs in the first year, 40% in second year, and 10% in each of the following 3 years. And that's the same thing. That's what you would do. So in this particular case now, trainings and development is a relevant cost. It's not a sunk cost. If you check at the top there, you will see some costs that are sunk. You will not use that one. So here now, trainings and development is a relevant cost. So you're also going to calculate it. So how do you do that? You have been told 120% of variable costs. What is your variable cost? Calculate your variable cost. Your variable cost is the cost per unit multiplied by the unit sold. That's your variable cost. So if you calculate your variable cost for year one, variable cost, what's the price per variable cost? Price per variable cost is what?
800.
How much is the price per variable cost?
800.
Price per variable cost
is 800 naira.
Okay, 800 naira. Okay, great. So for year one, 800 naira. 800 naira multiplied by the unit so that we'll get our total variable cost. 800 multiplied by 15,000 is what?
The inflation is charged at 5%.
The inflation is charged at 5%.
Yes.
Wait, variable cost now. Variable cost is, okay, charge the inflation on it first.